Okay, so you had a debt forgiven. Great news, right? But then, boom, you get a surprise tax bill. It's a really frustrating twist. Well, today, we're going to show you exactly how to handle that. We'll walk through how you might be able to legally wipe that tax liability completely off the books.
Right, so it all kicks off with this piece of paper right here, the Form 1099-C for cancellation of debt. Basically, if a creditor writes off $600 or more of what you owe them, they have to send one of these not just to you, but also to the IRS. And here's the kicker. As far as the IRS is concerned, that money you didn't have to pay back, they see it as income. And that leads to this kind of bizarre situation called phantom income. Think about it. You're getting taxed on money that you never actually saw. It never hit your bank account. It's just, poof, a gain on paper. But it creates a very, very real tax bill, and usually at the absolute worst time.
So, how in the world do you fight a phantom tax bill? Well, we've got a roadmap for you. We're going to cover the phantom income problem itself, then the insolvency exclusion solution. We'll get into building your insolvency worksheet, filing Form 98-2, talk about the hidden cost of this relief, and wrap it up with the key strategic takeaways. Let's dive in.
All right, first up, the phantom income problem. So why on earth is forgiven debt even taxed in the first place? It feels totally backward, right? But believe it or not, there's a very old legal reason for it.
This whole idea actually goes way back to a Supreme Court case from 1931. The logic they used was basically this. Think of a debt as a weight on your financial scale. When that debt is forgiven, the weight is lifted. Your net worth technically goes up. And the IRS looks at that increase and says, aha, that's a gain.
And it's not just some old theory either. It's written right into the law. Yep, Internal Revenue Code Section 61 makes it official. It says, by default, any income you get from having a debt discharged, well, that's taxable gross income. End of story? Or is it?
Well, here's the good news. The same tax code that creates this whole mess also gives you a way out. It's a really powerful tool, a kind of statutory shield, but you have to qualify for it.
That shield is called the Insolvency Exclusion, and the IRS is super clear about this. This has nothing to do with how you feel about your finances. It's just a simple, cold math problem. Are your total debts, your liabilities, more than the fair market value of everything you own, your assets? If the answer is yes, then in the eyes of the IRS, you are insolvent.
And this is a really important distinction to get right. You might feel insolvent because you're struggling to pay your bills month to month. That's called cash flow insolvent. But for this tax exclusion, the IRS doesn't care about that at all. They only care about balance sheet insolvency, a simple snapshot of what you owe versus what you own.
Okay, and the timing here is absolutely critical. This isn't a ballpark thing. The calculation is a financial snapshot taken at the exact moment immediately before the debt was canceled. Not the day before, not an hour later. That one specific moment in time is the only thing that matters.
So the big question is, how do you prove what your finances looked like at that one specific moment? Well, you have to build your case. You need evidence, and that means carefully putting together your financial picture.
And the official tool for this is the Insolvency Worksheet. You'll find it in IRS Publication 4681. I want you to think of this worksheet as your evidence locker. It's where you're going to gather up and organize all the proof you need to make your case to the IRS.
The whole process really breaks down into 3 simple steps. First, you tally up all of your liabilities. Second, you figure out the value of all your assets. And third, you do the math to calculate your insolvency.
Okay, step 1, tallying your liabilities. And you have to be totally exhaustive here. We're talking about everything, not just the big stuff like your mortgage or car loan. It includes all your credit card debt, and yes, that includes the card that was just canceled, student loans, medical bills, and even things people often forget like accrued interest or past due taxes. If you legally owe it, it goes on the list.
All right, now for step 2, valuing your assets. This is the other side of the coin. You've got to list the fair market value of everything you own. Bank accounts, your home, your car, stocks, even your furniture. But here is the one thing that trips almost everyone up. You must include your retirement accounts. Your 401ks, your IRAs, they all count. A big tax court case actually settled this, saying the law means all assets, no exceptions.
And now for the big reveal. You take your total liabilities, you subtract your total assets, and you see what you get. If the number is positive, like in this example, boom, that's your insolvency amount.
So here, this person is $8,000 insolvent, or $8,000 underwater. And that means they can exclude up to that much, $8,000, of forgiven debt from their income.
Okay, so you've built your worksheet, you've done the math, and you know your insolvency number. Now it's time to make it official. You have to actually file the paperwork with the IRS.
And let me be crystal clear about this. This is not optional. The exclusion doesn't just happen automatically. You absolutely must file Form 98-2 and attach it to your main tax return, your 1040. If you forget to file it, the IRS is just going to assume that 1099-C income is taxable, and you'll get a bill.
So how do you fill it out? It's pretty straightforward, actually. You're going to look at Part I of the form. First, you check the box on line 1B, the one for discharge of indebtedness to the extent insolvent. Then, on line 2, you write in the amount of forgiven debt you're excluding. But, and this is key, remember your limit. Let's say you had $10,000 of debt forgiven, but your insolvency worksheet said you were only $8,000 insolvent. Well, you can only exclude $8,000, not a penny more.
Now, this exclusion is an incredibly powerful tool, but it's not exactly free. There's a cost involved, a kind of trade-off that affects your taxes down the line. So you're probably thinking, okay, what's the catch? I mean, it can't be a total free lunch, can it? I just get to exclude all this income and that's it?
And you're right, it's not. The answer is no. It's better to think of this as a tax deferral, not a permanent tax forgiveness. The price you pay is something called a reduction of tax attributes. Basically, the IRS says, okay, we'll let you off the hook for this income now, but in exchange, you have to give up some other tax benefits you might have. It's their way of making sure you don't get to double dip.
And there is a very specific, non-negotiable order for how this works. The IRS gives you this exact list of tax attributes. You have to start at the very top with net operating losses and reduce them. Then you move down the list, item by item, until the total value of the attributes you've reduced is equal to the amount of debt you excluded. You don't get to pick and choose.
And to make things a little more interesting, not everything is reduced at the same rate. Things like tax losses, net operating losses, or capital loss carryovers, those get reduced dollar for dollar. Pretty simple. But tax credits, things like business credits, are different. They're only reduced by about 33 cents for every dollar of debt you exclude. Okay, we've gone through a lot of the nitty-gritty details, so let's pull back and lock in the most important things you need to walk away with.
Think of this as your action plan. Number 1, documentation is everything. It's your defense. Keep records of every single thing. 2, that worksheet is your proof. Fill it out accurately and then keep it forever, just in case of an audit. 3, Form 92 is not optional, it's mandatory. You have to file it. And finally, number 4, understand the cost. Be ready for that reduction of your other tax attributes.
So, when it's all said and done, here's the best way to think about this whole process. That Form 1099-C you get in the mail, that's the IRS making an accusation. They're accusing you of having income. And your carefully prepared insolvency worksheet, that's your rebuttal. It's your solid, evidence-backed defense that says, no, you're wrong.